Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about APLD, Applied Digital Corporation. This is an equity that, frankly, demands our full attention. It's situated right at this strange convergence of cutting-edge AI infrastructure and, well, its legacy as a crypto hosting platform.
And we've seen just extraordinary volatility recently.
Absolutely. Sharp upward price moves, consistently high volume, that really defined December of 2025. This whole frenzy was catalyzed specifically by the successful closing of that monumental, $2.35 billion senior secured note offering. The trading dynamics are they're extreme. Off-exchange trading, for instance, has been dominated by dark pool short volume, consistently exceeding 50% of trades. It even spiked to, 60.87% on December 2nd.
Yeah. And that extraordinary volume you mentioned, that volatility, it perfectly captures the core tension in this story. We are looking at a structurally complex entity that sits right at this intersection of powerful institutional validation, that huge financing round being the obvious sign, and on the other hand, significant, really deep-seated structural fragility.
Right.
So the central question for any sophisticated investor here is critical. Is APLD, as of late 2025, fundamentally validated as a stable, necessary AI infrastructure play by its new institutional backing? Or is its future trajectory really just defined by its precarious, highly leveraged structure and these unique, very complex market risks?
I firmly believe it's the former. The evidence to me strongly supports the narrative that APLD has been fundamentally de-risked. It's been validated by securing the capital it needs and executing a really crucial strategic pivot. APLD has, I think, successfully transitioned from being a low-margin crypto host, back when it was Applied Blockchain, into a high-margin provider of, bespoke AI cloud capacity. And this shift hasn't just altered its revenue stream, it has attracted what I'd consider the holy trinity of AI infrastructure: reliable power, significant institutional capital, and critically, technical validation from the industry leaders.
Okay, I come at it from a different way. That technical validation, while, I won't deny it's there, it rests on foundations that are just far too narrow for comfort. We can't just ignore the company's corporate genealogy. APLD traces its corporate roots back to a repurposed public shell with this bizarre operating history that includes aerospace parts, medical prototypes, and even, famously, a potato processing plant acquisition that was used to secure some development funds. This legacy creates an inherent conglomerate discount in the market's mind. It's an understandable skepticism that views the current AI pivot as, maybe just the latest opportunistic shift rather than a truly sustainable business model.
See, I think that historical baggage is functionally irrelevant now. The business model has scaled and matured so far beyond those origins. What is relevant, and what confirms the operational thesis for me, is the Nvidia stamp of approval. The public disclosure of Nvidia's direct equity stake, around 7.72 million shares, roughly 3% of the company, that is the critical piece of technical validation that dismisses all that skepticism about infrastructure quality. Nvidia does not invest over $60 million in infrastructure that can't handle the immense power density and demanding cooling of their cutting-edge GPUs like Blackwell and Rubin. This relationship immediately transforms APLD into a reliable Nvidia proxy for investors who need that high beta exposure.
That's a compelling argument, I'll give you that, regarding the technical side. But you're confusing technical capability with financial solvency and revenue stability. I'm just not convinced by that line of reasoning because the entire valuation, and therefore the equity, it hinges almost entirely on one speculative counterparty, CoreWeave. The estimated $11 billion in contracted revenue creates an extreme tenant concentration risk that you can't just wish away. In fact, S&P Global Ratings specifically highlighted this concentration issue when they assigned that speculative B+ credit rating. So yes, the Polaris Forge campuses are technically robust, but if CoreWeave, which itself carries a speculative grade status, were to face execution or liquidity issues, APLD's high-value, high-margin revenue stream would just evaporate almost instantly.
I see the concentration risk, I do, but I would frame it differently. I'd focus on the systemic nature of the AI supply chain. This relationship with CoreWeave, it's strategic, not just a simple customer-vendor relationship. CoreWeave is Nvidia's largest portfolio holding. APLD is positioned as the physical layer, the foundation for CoreWeave's rapid expansion. This triangular ecosystem, Nvidia, CoreWeave, APLD, it reflects the necessary tight integration you need to deploy these massive GPU clusters at speed and scale. This backlog isn't a vulnerability, it's a confirmation of APLD's irreplaceable strategic placement. Nvidia trusts CoreWeave, and CoreWeave trusts APLD's physical layer. That provides a level of embedded stability.
The problem is that the concentration risk dramatically outweighs that strategic validation. I mean, let's consider the actual consequence of a default. You mentioned the $11 billion backlog, but that revenue is contingent on those facilities being operational and CoreWeave paying its bills. If CoreWeave defaults or enters insolvency, the facilities APLD build are bespoke. They're engineered for extremely high-density compute. They need massive power inputs, specialized cooling. These aren't generic data centers you can just pivot to hosting someone like AWS or Microsoft. The collateral risk is immense. So the technical prowess of the infrastructure does nothing to protect APLD's equity holders from the potential financial failure of their primary and nearly sole high-value tenant.
And that risk is precisely why the debt deal was so crucial. Let's move to the capital structure, because this is where the de-risking truly happens. The $2.35 billion senior secured note offering in December was a massive success. The immediate overriding fear among investors, especially retail, was the dilution rug pull. The certainty that management would just issue massive amounts of equity via an ATM offering to fund construction. This high-cost debt deal explicitly removed that immediate threat. It secured the liquidity runway, it validated the hard assets, and it showed institutional confidence in the creditworthiness of that CoreWeave contract.
That's an interesting point about mitigating the ATM risk. And I'll acknowledge that avoiding immediate dilution was a huge psychological relief for shareholders. But was avoiding immediate dilution truly worth locking in nearly 9.25% annual interest for 7 years? Securing that high-cost debt transforms APLD from a development stage company into what I would call a highly leveraged real estate developer for servers. The company now carries a heavy interest burden that demands flawless, rapid execution.
But flawless execution is inherent to this business, and the market understood that trade-off.
But the leverage significantly raises the stakes. If management fails to meet those ready-for-service deadlines, even by a few quarters, construction costs could balloon, and those high interest payments start immediately, squeezing margins before revenue even shows up. Any significant delay, any sustained pressure from interest rates, it elevates the risk profile dramatically. In a worst-case scenario where execution falters, the equity is the first thing that gets wiped out, given the priority of those senior debt holders. This financial engineering hasn't de-risked APLD, it has simply swapped the transient pain of dilution for the existential threat of a credit failure.
I see why you think that, but the market's response in December showed that immediate relief from that threat of dilution was paramount for driving long-term value. Furthermore, the very market mechanics you cite as risk, they suggest a powerful suppressed upside potential. I mean, we consistently see short interest sitting at a stubborn 30 to 33% of the float, coupled with a tight free float and a low 3.4 days to cover ratio. The retail enthusiasm you see on forums focusing on a squeeze, it's rational because this structural imbalance is a proven driver of explosive price moves like what we saw in early December. The stock is structurally a coiled spring, regardless of the underlying reason for that short volume.
That's a compelling point about the market pressure, but you have to look deeper than the surface percentage. The core disagreement here is the interpretation of that short volume. The persistent high short volume, especially that 50 to 60% executed consistently in dark pools, is not primarily directional short selling anticipating failure. It's institutional flow that is a structural artifact, related to the financial engineering around the $450 million convertible notes.
But if I'm an average institutional investor, and I'm watching that 60% dark pool shorting, I panic. How do I reconcile that persistent high volume with your arbitrage thesis?
Okay, we have to look at two distinct opposing forces that are operating at the same time. First, you have the convertible arbitrage itself. Institutional funds buy the convertible notes to lock in a yield from the bond part, plus the upside from the embedded call option, to maintain a delta-neutral position, meaning they eliminate directional risk and just capture that arbitrage yield. They simultaneously short the stock. This process, long the bond and short the equity, systematically generates a massive short interest figure. And they execute the short leg in dark pools to avoid, signaling their move and affecting the stock price.
Okay, that explains the systematic shorting. But what about the other side of that trade, the buying flow?
That's the second force, the capped call derivatives. APLD, like a lot of companies issuing convertible debt, bought these capped calls from banks. These derivatives protect APLD from massive dilution if the stock price really shoots up. Now, the banks that sold these capped calls, they have to hedge their own liability. Since they are effectively short volatility and long the stock, they have to buy the underlying APLD shares to keep their own books balanced as the stock moves.
So you'd have note holders systematically shorting to hedge the bonds, and you have counterparty banks systematically buying to hedge the capped calls.
Precisely. And this dynamic creates a constant, massive institutional tug of war that generates immense daily volume. You get high short volume, high buy volume, and it often results in very little net price change on days with fundamental news. This flow just generates technical noise that entirely obscures true price discovery. Therefore, relying on squeeze euphoria is potentially very misleading. While the stock is susceptible to explosive moves if these institutional hedges are triggered, the trigger is based on financial engineering rules, not necessarily a fundamental bet against the company.
Regardless of the mechanism driving it, the reality is that the float is tight and technically suppressed. This suppression creates opportunity whenever genuine positive fundamental news hits. The Nvidia stake was positive news, the $2.35 billion in financing was positive news, and the price action reflected that violent, coiled potential. APLD has successfully transcended its shell company origins, secured Tier 1 institutional validation, and mitigated its most pressing capital needs. This company offers pure-play, high-beta exposure to the AI infrastructure boom, provided it maintains its execution momentum. The reward here, I argue, justifies the risk.
And I still maintain that the compelling narrative of validation dangerously masks systemic structural risk. The high short volume is technical noise, the core weave concentration represents a single massive point of failure, and the complexity of the leverage balance sheet makes the equity highly vulnerable to even minor operational missteps. APLD is fundamentally an execution-dependent, high-risk trade that requires perfect timing and flawless delivery. Investors have to carefully weigh the explosive potential upside against the very high probability of idiosyncratic risk derived from that single customer dependency and the crippling weight of a 9.25% cost of capital. The structural complexity here, it just cannot be overstated.
So, we have thoroughly discussed the conflicting interpretations of the recent institutional financing event, the strategic meaning of the Nvidia equity stake, and the complex interplay between the company's high leverage, its debt profile, and the unique market risks. It seems to conclude that APLD is currently a high-conviction bet on flawless operational execution.
And that the complex financial engineering, the convertible notes, the capped calls, means that a simple directional analysis, whether you are bullish on a squeeze or bearish on a fundamental failure, is completely insufficient to capture the full sophisticated risk profile of this stock.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights and see you in the next video.